Welcome to this week's special presentation, this week titled Avoid Retirement Shock. My name is Todd Schaefer, Manager of Research for VectorVest, and I'll be your presenter this evening. This week's topic comes to me via an email I received which reprinted a Wall Street Journal article titled Retirement Shock, Need to Find a Job After 40 Years at General Electric. As I read the article, I couldn't help but think how the subjects of the article could have had very different outcomes had they been students of VectorVest, and by extension, what lessons can we learn from their experience? Let's begin with some excerpts from the article to set the stage. As I indicated, the original story was sourced to the Wall Street Journal, and I've included the print edition reference if you'd like to see the full article. In it, you'll read roughly $140 billion in GE stock market wealth was lost in the past year, not just at Wall Street firms, but among former employees who, like many small investors, long believed the company invincible. About 43% of GE shareholders are retail investors, people who own stock in their personal accounts, according to the S&P Global Market Intelligence. Among those hard hit by GE stock losses have been company retirees, including former factory workers who took advantage of stock ownership plans to build their savings. For decades, the company has had a program that encourages employees to buy GE shares by offering to match 50% of workers' contributions, which were taken directly from their paychecks. The fall in GE stock prices has put more of the financial burden of retirement on pensions, which the article goes on to document are putting additional financial pressure on GE. Gary Zabrowski started working for General Electric in 1976 at an aviation factory in his hometown of Lynn, Massachusetts. The job paid well, came with benefits, and for Mr. Zabrowski provided a career ladder for a man with a high school education who started out cleaning toilets. You had a job for life if you had gotten in there, said Mr. Zabrowski, 61 years old. He rose to punch press operator and retired in 2016 after working 40 years at the century-old plant. He left GE with an annual pension of $85,000 and company stock valued at more than $280,000. Retirement looked pretty good until GE shares collapsed. His shares are now worth about $110,000, prompting a late-life job hunt. I never planned on retiring and having to go back to work, said Mr. Zabrowski, who has monthly mortgage payments and supports a partially disabled wife. It's kind of scary. Our next example is Jack Fay, 69, traveled for different jobs at the company, California, Kansas City, Louisville, before retiring in 2007 from the appliance division in Salt Lake City. Mr. Fay retired after more than 30 years at GE. When the company's share price tumbled in the financial crisis, he lost almost $300,000 in value. Employees need to think very carefully about investing their own money beyond 10% in company stocks, said Corey Rosen, founder of the National Center for Employee Ownership, a nonprofit that works with employees. If you're looking at retirement, then diversification is a good thing. In hindsight, Mr. Fay agrees. But at the time of the financial crisis, he thought most stocks were getting battered, so he might as well stick with GE. At the start of 2017, he had about $190,000 in GE stock, which is now worth about $70,000. He consulted with a financial planner about selling what was left, but he was advised to hold the stock. It was bound to go up, he said, the planner told him. Mr. Fay now doubts that it will, at least in his lifetime. I thought I was doing it right, but apparently I wasn't, he said. He hasn't talked to his family much about the losses, he said, other than to vent his once proud retirement was going up in smoke. Mr. Fay depends on his pension and Social Security checks. He uses the GE dividend to pay his car insurance. He and his wife have put planned vacations on hold, including dreams of a cruise in Europe and a trip to Australia. The way GE stock is going, he said, we might lose it all. For a frame of reference, here's a price graph of GE using weekly candlesticks with all the VectorVest data from 1995. A painful fall from grace after the 2000 high of $60, currently trading below $14. A 77% haircut from the high. So how could VectorVest have helped these investors, and what can we learn from the opportunity to learn from their experience? Let me start by sharing a list of resources for you. In particular, I want to focus on the asset allocation and retirement strategy essays. If we go back in the program and click the Views tab, in the Views Manager, you can access all of the historical essays that we've ever had in the program. A fantastic resource. Of course, you can search for a particular term Or you can also look at the essay viewer, which will list all of the essays in chronological order or by title if you sort on the title heading. I want to start by bringing your attention to the essay from February 7th, 2003. It was titled Asset Allocation. Dr. DeLito writes, "Many financial advisors believe that asset allocation is the key to financial success. I wouldn't go that far, but asset allocation is important, very important. Asset allocation is a large and complex subject, and I don't claim to be an expert, but I do know that there's a lot wrong with the way Wall Street uses it. The first problem I see is that Wall Street's advice on asset allocation is too general. A statement that one should have 65% of their money in stocks, 25% in bonds, and 10% in cash makes no sense since asset allocation is a highly personalized consideration. Every investor needs to determine the best asset allocation mix for them based upon their own ability to accommodate risk. When I started investing, I was told to buy stocks only with money that I could afford to lose. Profits were considered to be frosting on the cake, so to speak. That made sense to me, so I invested only a small portion of our savings in the stock market. As my earnings power increased, I was able to allocate more of our discretionary income to stocks. When I retired at a relatively young age, more money went into bonds. At no time did I risk money in the stock market that would jeopardize our children's education or our standard of living." He continues, "First, determine how much money you can afford to lose. Invest that in stocks. If you can't afford to lose any money in stocks, then buy high-quality notes or bonds. Don't get caught up in this business about young people affording more risk than older folks. Risk is not a function of age, it's a function of earnings power. If your earnings power is low, young or old, you need to be biased toward investments with lower risk than stocks. Secondly, recognize that Wall Street's guidance is based to favor stocks, so don't pay that much attention to it, or at least compensate for it. When they say 65% in stocks, you may want to think 50% in stocks. Actually, you're much better off tracking our guidance on market timing, cut back on the long stock positions in down markets, increase them in up markets. Thirdly, never have more than 75% of your discretionary money in stocks. I met a guy in Seattle several years ago who was 100% in Microsoft. He was getting rich. Nevertheless, I advised him to put at least 25% of his money into bonds no matter how great he thought Microsoft was. A year later, he thanked me for my help. And diversify among the stocks you do own. Never have more than 50% of your portfolio's value in the stock of the company you work for. Look what happened to the poor devils at Enron, US Air, WorldCom, and so on. Could you afford to lose your job as well as your stock value? Finally, don't let greed and impatience get the best of you. Set achievable goals and let common sense be your guide to asset allocation. So first, diversify your assets across several asset classes. For the assets you are going to invest in the markets, let me refer you to our next essay. This essay was the fourth in a series of essays where Dr. DeLito took on the task of devising a management plan for retirement portfolios. The paragraph I want to highlight for you in this essay: "My biggest concern regarding the idea of managing stocks for current income is that of losing sight of capital preservation. In other words, you may become so intent on capturing a dividend payment that you end up holding stocks that should have been sold. Consequently, you will lose a lot more money than you could have possibly made in current income. Don't let that happen to you. Capital preservation should be your top priority. So to preserve capital, we have to be willing to either sell the stock or hedge against any downturn with option trades. We offer several options courses to help you learn this valuable skill. For guidance on when to sell, let's use GE as our case study. Let's change from our all data look-back period to just the last 10 years so we can look at the performance since coming off of the downturn in the financial collapse. I'm going to add to this graph our recommendation profile. On this indicator bar, you can see then the buy, sell, and hold ratings for GE over time. Since the end of the financial collapse, GE has struggled in particular here in 2010, 2011, and of course the current pain we've been suffering. For the conservative investor, we're trying to hold these positions as long as possible, but also protect our portfolio from significant loss. We want to strike a balance between riding out the dips and closing quickly enough to avoid that significant move. It seems clear here with hindsight It's a little harder when you're trading the hard right edge of the graph. So you have to plan your trade. Choose the signal you're going to use. When you get that signal, what are you going to do? If you sell, you can always buy back in when the downtrend ends. If you hedge with options, you don't have to sell. You can continue to collect your dividend, and for a relatively small price, you've protected yourself against significant loss. Let's zoom in one more time to a 5-year time frame so we can see even more detail, and I'll add the VectorVest stop price to the graph. You've often heard us say that our stop price is our line in the sand. Any stock that's reached our stop price should be reviewed for sale or for hedging. Remember, the stop price is an adjusted 13-week moving average of the price action adjusted for the fundamental strength of the company. We adjust it lower or move it away from price for companies that have strong fundamental scores, and move it closer for companies that have weak fundamental scores. The sell rating is derived when the price closes below our stop price. So when the price falls below its 13-week moving average, even with the adjustment, we think that's a pretty good indication that you need to look at the stock. And in this case, pretty good advice. And of course, if GE is only a part of your broader portfolio holdings, the adverse move will have a smaller impact on your overall portfolio performance. And finally, I want to point out to you one more very important resource. Back on the Views tab, in the Views Manager, if you click on Special Reports, you'll find our Guide to Worry-Free Investing. And once again, I'll quote Dr. DeLito from his essay, Generating Income via Worry-Free Investing. The ultimate solution to a satisfactory retirement is to just keep making money. Investors can make money from the comfort of their homes via capital appreciation and by generating income. We've been teaching investors how to generate steady, reliable income for many years now, but we've never been more confident in the efficacy of our training than we are with worry-free investing. And so to recap, the first key is to diversify your holdings, particularly as retirement approaches. For the equity portion of your holdings, consider high RS stocks a la the worry-free investing method. Never sacrifice a large hit to the capital value of your investment in a quest to maintain the income. Devise a plan before you need it on when you will take action and what that action will be. Sell or hedge when the stock moves against you. VectorVest has all the resources you need to learn how to avoid retirement shock. Thank you for watching.